Okay, today is June 10th, 2024, and our agenda today is to talk about the 22C, or the Seller Financing Addendum. So personally, I've only used this form just a handful of times in my entire 10 years experience. So what I have personally on this form is a little bit more limited than some of the other ones. This forms class today is going to be more of an overview and a pretty broad generalization of basically just looking at this form, talking about its uses, and the execution of the actual form itself. So this form was actually created to give some lending guidelines to sellers and just to kind of establish those rules and regulations for people who want to finance their own property. For the most part, sellers can use or can sell their property to as they choose, to whomever they choose. So there are, however, federal regulations that they need to follow because depending on certain methods of transfer in their sale, they are going to be dealing with things as a lender might deal with them. So sellers have the option with the 22C to basically be the financier. They are acting as the lending institution or the bank. So think about that for a minute, right? What do you know? How much do you know about what it takes to be a lender? Well, kind of like we are held to the standard of care as a lawyer, when a seller decides to become a lender, they're going to be held to a certain standard as well. So this form is going to kind of help dial in what those things are. When it comes to residential sales with homes, there are regulations that control the financial transfer, even when it's done privately. So because of this, the 22C is in place for the disclosure of the sale transfer, where the seller is financing the sale and the property is going to be used as a residential dwelling. Using this form should be carefully considered. There are quite a few options when it comes to how we transfer and how we do this financing form. We'll talk about this as we move into the form itself, but that is the reason it can be quite complicated. So if the seller is financing the sale and the property will be used as a residential dwelling, then both the seller and the financing method must comply with these rules. These rules are listed under the general terms. First of all, you need to decide if this will or will not be used for a residential dwelling. And the definition of that is if you can think about the time that the payments are going to be made to the seller, what is the use of this property going to be? Now, if this is a vacant piece of land and that buyer wants to just have that seller carry the contract until they can kind of secure the building plans and construction loan and then convert it to something else, then it wouldn't technically be used as a residential dwelling. Now, if there is a home on it and the buyer is moving in, making payments to the seller, then absolutely 100% it would qualify as residential dwelling. In order to finance it through the seller, the rules must be followed as listed below. So number one, the seller has to be a natural person. They cannot be a lender. They can't be an estate or a trust. It has to be a person. The seller has not financed the sale of another property within 12 months. So the seller can't just go buy and then sell, buy, sell, buy, sell. These are not flipping methods. And that's because liens get placed, liabilities get placed. So number three, the seller did not construct or act as a contractor for the construction of a residence on the property in the ordinary course of the seller's business. So again, this isn't a method of flipping. This is to keep away that idea of predatory lending, under the table lending, right? This is just for the transfer of real estate when constructed in the normal course, not as a person taking these items, flipping them. The repayment schedule does not result in negative amortization. The financing has a fixed rate or an adjustable rate that is adjustable after 5 years or more, subject to the reasonable annual and lifetime limitations of the interest rate. So don't worry if you don't remember all these rules or you don't know if your person qualifies for these rules. We want to make sure that the property is, first of all, not being used for, if the property is not being used for residential, we can just remember in our heads that this does not apply. They don't need to worry about getting what they call a waiver. And these regulations, again, have been put in place to just protect the consumers. So if those general rules are met, if the property is currently being used for a residential space, then you're going to need to get what they call a DFI waiver, or the Washington State DFI waiver, or the exemption is required. So these can be found at WSBA.org or through the escrow office that you're working with. You're going to want to talk to the escrow team to see if they have experience doing seller financing. These specific forms that they're requesting from the 22C are not statewide forms. You are not trained on them. We do not know how to interpret them, and we're not actually going to be the ones to fill them out. You may provide them to escrow in their blank form, or you can direct the closing team to pull those forms for you. But in any case, those forms will be attached to purchases and sales that are going to be using these things. Now, you should definitely read them and maybe familiarize yourself with some of the terms that are going to be listed on them. But again, don't worry about the actual act of filling the forms out. So a seller who wants to do seller financing has 5 days to obtain this waiver by default. That date can be changed. This waiver is not incredibly lengthy, and it's not very hard to get. Washington State tends to make them very simple to obtain. And there's also no harm in applying even if there is an exemption. So the important part is making sure that if your seller is doing seller finance, that you get that application in as soon as possible. Now, the disclosure: the seller must provide the buyer with all material information regarding the loan and the cost of financing, as well as, the same as any licensed lender. These rules are basically part of Regulation Z, and that is something that all regular lenders do have to abide by as well. It's the right of the buyer to know all this information. There are various forms referenced in the 22C. And bullet point D right here refers to what they call the Limited Practice Board forms. So the various forms that they're referenced in this are required to be attached to the agreement, and they are not going to be filled out but attached blank. In most cases, a title company or escrow company will take care of filling the rest of these out. So this responsibility is on you for keeping good communication, but not necessarily filling out the forms. And these Limited Practice Board forms should be kept on file with our brokerment file. So as soon as they're filled out with escrow, we want to make sure we have a copy of those. Make sure you are CCing the TC so we can just keep everything all together, because this form does reference specific forms that need to be attached. This is just a screenshot of some of the forms that are available through the Limited Practice Board and might be needed to go with the Seller Financing Addendum. As a reference point, you're going to be identified on which forms are required in each line item. And just as a general rule of thumb, when it has a little I in parentheses, that means it's for an individual person, and an R means it's for a representative of maybe an entity. So per our agency duties, you are required to advise the expert in your area that exceeds the scope of your knowledge. So this form has a built-in clause that calls out for an attorney review. Absolutely take this opportunity. You get 5 days. Now, seller financing transactions are complicated and not considered a normal real estate transaction. So no one here is a lender or a title officer. So we're all going to be in the same situation as far as what our scope of expertise is. Now, the attorney review is an option for all parties in this contract. It's going to be needed for buyer and for seller. If the parties have to give notice if they disapprove or object, right? But if anything changes in any of the forms that are written up, there's actually a requirement that the attorneys have to review them. And in that case, they have to accept them. So 2 parts here. One, everybody gets an attorney review to look over what you've done. If you've changed anything, it is required that attorneys approve your change. This change has to come in writing, and there also is a timeline for that to happen. These also bullet point consequences for not meeting our deadlines. So please do not handwrite any of these clauses or paragraphs in on a 34. These have consequences and timelines in this form here. Now, a lender may still hold the first position. So a seller may not end up being in the space they think they're going to be. Let's see. I'm sorry, I skipped a slide here. If any changes are made again, then it's mandatory for the review. Both attorneys have to accept the changes and proof of approval has to be sent. So the purchase and sale will automatically terminate if the changes are not approved by both attorneys within their 10 days. You can actually change this timeline, so feel free to do that if you need to. But basically, if any changes are made, it is mandatory to get approval for that. So how do we show seller financing? Well, paragraph 2 is where it bullet points all of the required information for us to put down as far as disclosing per regulation Z. So think about the down payment and what it means. Think about what items we need to get paid when the seller puts down money and brings money to the table. Keep in mind, we will have closing fees, maybe escrow fees, title fees, compensation to brokers or any other party that's involved. And then, of course, anything that goes into the seller's pocket to start this, right? So keep that in mind when you're choosing how much earnest money plus additional down payment to be your total money to the table. Then the balance, the interest rate, balance of the purchase price is going to be the interest rate that you are paying to that seller, when the interest is going to be beginning, and this closing would be on the closing of this purchase and sale contract. So as soon as buyer takes over contract. Now payments to the seller. Are you going to be making installment payments? Are you going to be making monthly payments, quarterly payments, large lump sum? This is how you bullet point exactly what your payment schedule is going to be. It's very important that we make sure we communicate that clearly in paragraph 2. Now, there's 2 different ways that a title can be transferred once the sale closes with seller financing. One is what they call a promissory note and deed of trust, and the other one is called a real estate contract. Those are 2 completely different ways to transfer title with very, very different consequences. So this is going to be probably the most confusing, but the most important thing to keep in mind, because one of them is a little bit more preferential to buyer, one of them is a little bit more preferential to seller. So promissory note and deed of trust. What is it? Well, a promissory note is a promise to purchase. And then the deed of trust is essentially what we transfer at closing in a typical real estate transaction. So you'll have a contract that says, I promise to pay. And then you're going to have a deed that says, this is in my name and I promise to pay it. So this promissory note and deed of trust is typically more preferred with buyers. And the reason is a traditional buyer will hold the title just as they do through a typical lender. And then the seller would have what they call an interest in the property. So the seller is more or less like almost like a lien holder of the property, but the seller's name is off of the property's title. So everything gets transferred to buyer at closing. Seller is just a lien holder, and buyer basically owns that property and is making payments to the bank of the seller. At the closing, the buyer gets the deed. The property, the buyer owns the property, not free and clear. It's encumbered. It's an encumbered title, but the promissory note is just attached. So the promissory note is something that's not actually recorded. It's just a promise of payment documented, okay? Keeping that in mind, that it's a promise to pay, that document is just kind of held, and the deed of trust is really the only thing that shows who is going to be responsible for paying. Now, if the buyer is in default, the seller basically has to foreclose on the property to recover it. They have to go through the process. The foreclosure process can be lengthy, can be cumbersome, it can be expensive, and it has to be done the correct way and legal way. If a seller is seller financing and ends up having to foreclose, if they've missed a step, the foreclosure will not have happened and they still cannot retain their property back, whether buyer is continuing to make the payments or not. So keep that in mind. It's a higher risk to the seller. Of course, it gives buyer complete freedom because buyer now owns the property and the seller is more or less the financial entity that's accepting the payments. So with this option, there is a limited practice board form that also has to be used. And right here, we have the deed of trust and the promissory note. So what I did is I just pulled the first page of them so you could see what they look like. Promissory note on the left, deed of trust on the right. They are both several pages long, but this is more of a familiarity. All right, now any contract agreement has to have an end date. All of ours do. That's how we make sure that this is a date of performance and we can enforce this contract. So first bullet point right here is the end date of this. When is that balance going to be paid in full? This is the only way that we can enforce legally. With no end date, that means there's no due date to have the completed items in this contract finished. Now, your seller should not want to hold open the idea of being the bank forever, okay? And a lengthy seller finance is just very, very uncommon. Typically, we will see a shorter seller finance so they can maybe get over a financial hump. And then maybe avoiding multiple closing fees, right? So there's really not a huge benefit to stretching this out in seller financing. Public interest rates change, the market's going to change. And although it might be right for the time, you definitely do want to have an end date. Now, in the event a buyer misses a payment, there is a default provision, and that default provision notes the penalty. Now, if you put in the same as a standard interest, say you're doing a seller finance at 6%, and in the course of the default, you're going to say, well, the penalty is going to just be the 6%. And if you can't pay me, I'm going to give you another 30 days. Basically, what you're saying is there's no penalty for having a late payment. So if you put your seller's mind in the same mind as a lender and find, I have more risk in doing something like this, less risk in this, you may want to consider putting in some sort of a penalty for having a missed or late payment. Otherwise, what motivation does that buyer have to make on-time payments? So now what risk is the seller taking on when they do this? That fee is going to be based on the amount of risk. In the past, I've always maximized this number because I want that buyer to know, I want you to make your timely payments, but if you're late, there's a huge fee. So let's work really hard on making those timely payments. There are reasons that banks have high penalty fees as well. So sellers acting as a bank, just keep that in mind. Now, no further encumbrances. So encumbrances, I'm sure we remember back to when we all got our real estate license, and one of the main topics of our real estate license was encumbrances. So this is the first time we've probably seen that since we got licensed. And yay, we don't have, we have a use for some of our knowledge back then. But basically what encumbrances are is anything that's put on to this mortgage. Let's talk about it like in the sense of mortgage. So a buyer cannot go into a seller finance, take that seller finances, take the seller's home, keep it in the deed of trust, so keep it in the buyer's name. Seller's still responsible for making payments, and buyer cannot go on and use that as collateral for something else, right? The buyer has to own that property before they can use it as any sort of asset that they personally own. So if buyer wants to use that home for an asset, or they want to put a claim against it, or if there's any liens or second, third, fourth mortgages, anything that happens with that, the buyer needs to be owning it and not making payments on it. And this box right here has to be checked if that seller wants that buyer to not use that property for collateral in any way. Now, real estate contracts. I said there were two different kinds. There was the note and deed of trust, and then there's the real estate contract. So real estate contracts are a little bit more preferred by sellers. So think about what note and deed of trust was. It's something that transfers title to the buyer's name at closing with a promise of repayment where the seller is a financial interest in the property and not a legal owner. The real estate contract is essentially the opposite of that. Real estate contracts say the seller will not give the title to the buyer at closing. The seller remains the owner. The buyer takes an interest in the seller's property, not the seller, not the other way around. The buyer has rights. They can potentially, as you listed below, they can remodel the house. They have possessory rights. They can possess the property. They can live as if they own the property in almost every sense, unless there's an agreement not to. But the name of the title is still in seller's name until that balance is paid, at which time it transfers to the buyer. So the buyer has an interest in this real estate contract, not an ownership. The buyer must make payments. If the buyer fails to make payments, there is no need for the foreclosure process, but rather what the seller does is what they call a forfeit on the buyer's ownership. So it's a lot more fluid and simple for a seller to take back a property that has a default in the payments when you have a real estate contract versus the deed of trust. It's still not, an overnight thing. It's still going to take all the legal ways of doing it, but there is a faster path to possessing the seller's property back should those payments stop. Cash out is also your end date. This means at the very end date, this is when the property must be paid in full, and that can be negotiated in that bullet point down below. Now, assumed obligations. Is there a financial obligation that the buyer will be assuming? Is there currently a mortgage on the property? If so, you're dealing with now a third party. So we need to make sure we are writing that balance here. The buyer should know if there are underlying obligations, and the seller also needs to be aware of how those have to be paid in order to keep it from being in default. You will need permission from any financial holder. So this provision gives that time to get the consent from the seller's financing, for the seller financing when another party holds that financial interest. If there is a mortgage, get the approval. A mortgage lender can demand the balance be paid at that transfer of title when you transfer it from the current, it's probably in a deed of trust now, to a real estate contract. As soon as that's up, that mortgage broker can demand what they call a due on sale, which is, I want to be paid my entire balance right this minute. So you need time to figure out if that's going to happen. Nobody wants to be surprised by that. If that's how they're set up, that's how they're set up. So check these things out before you let your buyer or even seller get into a situation that you may be stuck in. Now, if there is an underlying loan on the property that has to be paid from the buyer's payments, you can also check this box. It's called the seller wrap of existing loan. So basically what it says is these payments are going to come in. The buyer is going to be paying the seller monthly payments of I'm going to throw out a number, $5,000 to an existing loan by the lender. Okay. Now they have an approximate principal balance at a certain interest rate. And the way the seller wrap loan works is it pays that mortgage first and ensures the payment of that mortgage payment, and then the remaining balance goes to seller. So an example of a wrap loan would be something to the effect of property sells for $100,000. There is a mortgage balance of $60,000 in a current deed of trust. The buyer's payment would go to pay off the mortgage 60 first, and then the remaining to the seller. So it is highly advised that you use a collection agency if you want to make payments such as this, because if the seller fails to continue their payments and keeps the loan in their name, then that lender is probably going to be holding first position. That seller could potentially default on their own mortgage, but buyer's living in the house, so seller's not going to get kicked out. And the buyer will be the one that ultimately suffers because they're going on thinking they're making these monthly payments that are not actually going to pay off the loan, and seller's defaulting. Another option you can do is cash down to the existing loan. So this is, cash down to the existing loan. So this is when a new buyer puts additional down payment on a current mortgage and then gets approval to take over that interest rate and convert that mortgage to their name. They have to have a sufficient down payment. And but this is actually a really good option for those who can, keep over and assume that like 3% loan. This is really good for buyers that are equipped with a large amount of cash to make up that difference. And there are protective provisions in this form. So if you want to do this assumable loan, this would be the box that you want to check right here. Again, you do have the option of doing either a deed of trust, mortgage. You'd have to talk to the mortgage lender as far as what that would mean. I didn't have a good definition on what the mortgage would be. So talk to a lender on that one, or the real estate contract. And this would be necessary for you to put cash down for. Now, assumable terms. The slide before was considered an assumable loan because essentially what you're doing is you're putting down payment towards a loan that already exists and continuing to pay off the balance of that loan, just changing it to a different person's name. I know the VA is, it's common for the VA to see assumable loans. This is exactly where you would put that information. And this is a continued terms for using assumable loans. You will have to specify the payments and interest as still required by law. This is again part of Regulation Z. You will also want to check the other boxes to ensure that the loan is in fact assumable. You want to basically the buyer and seller review period. You're going to want to make sure that the seller warranty, the loan is assumable. Not all loans are assumable. So buyer and seller have the option of a review. And because these options are not common, I would use these contingencies to just make sure that you can, in fact, assume these loans. What if there are penalties that come up? You just want to make sure you know everything you're getting into. And again, as soon as you fill this out, the buyer has the right to have an attorney review on this. All right, so I pulled a question that I thought was a little bit relevant to what we're seeing today. So with high interest rates, we're starting to see more sellers willing to do VA assumable loans. Form 22C, paragraph 3, section D says the seller may remain liable to pay the holder of the assumable loan if the buyer fails to do so. Once the loan has been transferred to the buyer and removed from the seller's name, how can they still be responsible? Also, if they are still held liable and are using their VA loan to purchase another property, is that liable amount counted against their entitlement amount? So the answer is the provision of Form 22C identified the question, in the question, puts the seller on notice that the lender's assumption package may cause the seller to remain liable, and for that reason, the seller retains the right to review the loan package and terminate the purchase and sale agreement if the seller is not satisfied with the terms of the buyer's assumption. If the lender does not relieve the seller of all liability under the assumed loan, the seller may terminate the PSA and prevent the buyer's assumption that would leave seller remaining liable. If you choose to use a collection agency, which you should, you would need to establish this in advance. You also will have the flexibility to delegate escrow, taxes and insurance, and payments through this form. Seller's review of buyer's financing contingencies. So is your seller going to act as the bank? If so, then let them fully act as the bank. Option B right here, the seller's review of buyer's financing contingency, just gives the option that your seller may want. Maybe they want to see before deciding to act as the lender with the buyer. Will they want to know their credit score? Probably. How about their tax returns to verify their income or their income consistency? You bet. And how about buyer's employment? Yes. Okay. Sellers need to get ready to ask for these things as being the lending institution of this transaction, which we all know because of our prices of real estate, these are not small transactions. Sellers need to be prepared to ask for these things, and buyers need to be prepared to deliver these things if they are going to be asking for the financing of that seller. I just wanted to put a quick blurb in about commercial sales. Commercial has their own forms that can be used alongside with the LPO forms. Some of these forms can act in replacement of the LPO forms, like the promissory note, and some of them are just used in conjunction with them. Just keep this in mind when you're filling them out to request the forms, and I'm really not going to go into commercial too much. Okay, well, that was complicated, and we barely scratched the surface of that form. So there are contingencies that you need to be aware of when offering your buyer and seller, especially when when a seller becomes the lender. Remember that they are held to the same Washington state financial laws as lenders when it comes to Regulation C. I hope that this helped familiarize you guys a little bit with some of the uses in this. And if you need a more in-depth explanation, or if you find yourself using these in real estate transactions, reach out to a managing broker, designated broker, or a qualified escrow team to help walk you through some of those details. Thank you for listening.